my name is RJ Kelly. I'm founder and chief visionary officer for Wealth Legacy Group. We have a beautiful home office here in San Diego, California, although we've got clients now that we've just had someone in Maryland. I think we're up to 23 different states that we have clients in. So wherever you're watching this from, welcome. So glad to have you with us. And I am so pleased to be able to have a dear, dear friend, Lou Bojorquez, with us, who has been a tremendous assist to me and to my wife in our own portfolios and getting to meet an organization you're going to hear more about in a minute, but also for helping us think broader. Because what we're finding, and we've got a new book that's coming out shortly called Radical Retirement Roadmap, and we'll talk about that one. We'll talk about that one at a different event. But what we found in our research, so my co-writer, Caitlin, and I have found that Americans are really concerned about their retirement and how can they make their funds last? How, with this volatility, or what I like to call wiggle, that we're experiencing in this incredibly disruptive economy that we're in, how can we know and have confidence, or at least a high confidence, that we're never going to run out of money? So with that in mind, I was chatting with another dear friend of mine, Lou Tranquilli, on the other coast, and who manages a very large book of investments for clients. And he asked me one day, have you ever heard of, RJ, have you heard of Beacon Capital before? I said, I have not. Who are they? He said, well, you need to meet Lou Bojorquez. He's over on your coast, and ask him about Beacon Capital. And so that led to now a friendship going back, I think, almost 10 years. So again, Lou, it's so great to have you with us this morning. And with all of that long preamble, you are connected with this amazing company called Beacon Capital. So who are they? What started Chris Cook, this amazing math quant that's the guy behind the numbers and the concepts? What are the risks and issues and things that created Beacon Capital? So again, great to have you with us. Thanks so much.
Thank you for that introduction, RJ. Your question, who are we? Who am I? So I've been with Beacon Capital for 8 years now. I'm really pleased. This is a company that I really have a lot of belief and faith and passion in. Our corporation, Beacon Capital Management, is based in Dayton, Ohio. We are a boutique portfolio manager that specializes in protecting clients from catastrophic loss while being invested in the capital markets. They were founded by Chris Cook. Chris Cook is our CEO and portfolio manager. And as a response to the bear markets of 2000 to 2002, and also 2007 to 2009, he was trying to find a way to still participate in the equity markets, but protect clients against these recessions or catastrophic downward moves in the market. Mm-hmm. Using his experience from his own clients, he went into the lab, as I call it, and he created a couple different processes for managing money. And that's how Chris came to start Beacon Capital.
Well, you had, what was it, the saying that, you had me at, so in this case, you had me at how do we protect our money in those down market cycles? What can be done? So I think one of the things that caught my attention early on was Beacon Capital has something that I don't see used in the market, although it makes tremendous sense. And that's a stop loss. So when then certain factors, certain things happen, that a sale occurs, there's a transition in the portfolio, so that if because I'll let you speak to the probabilities and what's been selected and so forth. But that was one of the things that caught my eye, is how can we protect our capital, our investments, when the markets all of a sudden get very choppy and go down by 10%, 15%. What about 37% back in 2007? So speak to that, if you would, please. What is the stop loss that Beacon incorporates?
So we implement a stop loss strategy. And what that does is it allows us to participate in the markets until they reach a market high. And when our benchmark drops 10% from that high, we exit the market and we receive yield in fixed income investments. Now, the obvious question is, well, that's great. You get out at 10%. Why is that important? Chris in his studies found that when the benchmark drops 10% for us, 1 out of 2 times it drops 20% or more. So that means 1 out of 2 times we're on the right side of the trade. 1 of the 2 times we need to get back in the market again. However, 1 out of 4 times the market drops 40% or more. And that's really where we make our gains as a portfolio manager. When the markets are down 40% and we're able to re-enter the markets at a lower point, that's where we really help out our clients. So our first portfolio is a stop loss strategy.
I remember saying that also caught my attention very quickly early on when I saw that in 2008, when the overall market, the S&P index, was down by over 37%. So I thought, well, how did Beacon do that year? And if I recall, it was about 8 or 9% positive return, and yet minus 37% in the equity markets in 2008.
So here's a graphic that shows how our stop loss strategy works. It shows we invest in all 11 sectors of the economy. As the market rises, we continue to note that. When it finally reaches a high, we mark it, and should it drop 10% from that high, we exit the equity ecosphere and go into a yield-bearing instrument, U.S. Treasuries. But the logical question is, well, when do you get back in? Same thing. We use a mathematically reasonable process for getting back in. We're not guessing. It's all based on mathematics. And what this chart shows, the zero, the bottom left-hand corner here, is measuring the point from which we get out of the market. At that point, the markets have come down 10%. We need a 15% recovery to get back in the market. However, what often happens is another low is established. So let's say an example where the market drops and then 60 days later, it hits a new low. We come back to this chart and we say, okay, a new low has been established. It's 60 days. We're now going to need a 19% recovery from the new established low. You think of a year like 2000 to 2002, that 2-year period continued to reach low after low after low until ultimately, after 360 days, our final buyback is 25% to get back into the market from the all-time low.
So I think, Lou, that really gets to your point that you were saying, is that when the markets drop on that basket of, and we haven't gotten there yet, but I was also surprised to find out that there are only, wait for it, 11 sectors that make up the U.S. economy. That's it. There's not 27. There's not, not 50. No, there are 11. And of those 11, 2 of them are just for consumers, consumer durables and consumer spendable. So not that many sectors to have to track. And that's the beauty of the Beacon platform, is it's so low cost because for the most part, we're using Vanguard sector funds to be able to invest, get the breadth of the whole U.S. economy at a very, very low cost. But again, it was surprising to me in some of these years when we've had tremendous market volatility, how well Beacon has done in those years. So it gets to your point. You're not going to guess right every time. And as I understand it, I think there have been 14 recessions since World War II, something like that. So there was a great deal of data for Chris to study in coming up with these algorithms that, while not perfect, will keep us more often than not on the right side of the math. And Lou, not only is it prudent to know when to get out of the equity markets, but how do you get back in again? What if because in 2020, for those that remember, it was a very rough start to the year. The markets just went crash and burn. And at one point, we're down by over 30% just in the first month, and then rebounded from there. But so many people pulled out and they never went back in again, including some very well-known institutional portfolio managers that missed the whole rise in the market that happened in the start of the second quarter. So how does Beacon address something like that? When do they decide to get back in? That's as important, I think, to know, is how do they decide when to get out? So could you speak to that for us?
Right. So two things. The first thing you mentioned, RJ, was sectors. And folks asked us, why do we invest equally in all 11 sectors? And that's actually our
Mhm.
first line of defense before we get to the stop loss. Because we find, sectors like technology or energy can be very volatile, but there's other sectors involved. So our first line of defense is to have a correlation that's not equal to the market. We want to be prepared in periods of contraction, periods of market expansion, and we do that by investing in all 11 sectors. How do you not choose just one sector, overweight your portfolio to one sector? What you see on the screen here is a quilt type of diagram that shows each of the 11 sectors from 2010 to 2022, and they have different colors so we can easily follow them. I like looking, let's start with the red one. Look at utilities. In 2010, utilities was one of the worst performers. So as a portfolio manager, you think, well, I don't want to invest in that. However, the next year, utilities is at the top. So you decide, okay, we're going to go ahead and stay or maybe even double down on utilities. The next year, it's the bottom. And you can pick pretty much any sector here, perhaps healthcare. See, healthcare is on the bottom the first year. Next year, it's closer to the top, closer to the top. And they go back and forth like this. But what we found by using 11 equal weighted sectors, we're pretty much in the middle of the range all the time. This is our first line of defense, to use all 11 sectors and have a diverse portfolio for our clients. So Chris found that losses have a more powerful effect on investment returns than gains do. This slide right here is very simple, but it shows if a portfolio drops 10%, what does it take to get back to even? And the chart here says 11%. So not 10%, which is what most folks think. An easier example is if the portfolio goes down 50%, does it take 50% to get back to even? Absolutely not. The real answer here is it takes 100%. Example, $100,000 in 2000 to 2002 drops to 50,000. You don't need 50% to get back to even. That would only get you up to 75,000. You need the full amount, the full 50. And knowing that if you average 10%, it's going to take a number of years to get back to even. I love this slide. This is an illustration that shows the hare portfolio versus the tortoise portfolio. We all know the fable of the tortoise and the hare. And what we find in the hare portfolio does 2 times the return of the tortoise portfolio in good years, and it does twice as poorly during bad years. So an example, in year 1, the tortoise portfolio does 13.23%. The hare does 26.46%. In a down year, the tortoise portfolio goes down 18.5%. The hare portfolio goes down 30%. But the question is, which portfolio ends up with more money in the long run? When we look to the bottom of the portfolio, the tortoise did just a little more than 0.5% on average. And the hare did twice of that, 1.21%. However, when you look at the account values, the hare portfolio is $10,000 less than the tortoise portfolio. How can that be? And the answer is losses have a greater mathematical impact on a portfolio than gains do. Now, with that being said, when we do stop out of the market, and let's say like a 2020, market came down 10% from January 4th until February 27th, 2020, we received the call to get out of the markets, and we got out of the markets completely. After that, the markets went down another 24%. So they had dropped from peak to trough 34% before hitting a bottom. So when we decide to get back in, has to do with how much time has gone by and what it takes to get back to even. We have a chart that we use that we reference every time we hit a high and every time the market hits a new low once we get out of the market. Our initial buyback is 15% from an established low. So 2020 was very unique because it dropped down so rapidly. And when it hit that bottom, we received a 15% rebound on March 27th. Now, what's interesting about that, RJ, is even in my own life, my own golf club closed down on March 17th. They wouldn't even let us in the door. And here we received the call to get back in the market on March 27th. You know, my first initial reaction was, no, everything's closing down.
I had a few clients with that same reaction as well. It's like, no, what are you doing? Okay, keep going.
So fully invested on April 1st, and, you know, history, you know, shows from that April to the following April up 60%. So using an algorithmic strategy and not emotion worked out for us in this case. Similar to 2022, similar to 2008, we get out of the market knowing mathematically that 1 out of 2 times we're going to be right, and 1 out of 4 times we're going to be really right.
Now, as we're talking about these just stupendous returns that we saw in 2020 and 2021, there were equally some painful returns in 2022 and 2023. But I'm also hearing my compliance attorney in my ear going, past performance is no guarantee of future results. So for those of you who just heard some pretty impressive numbers a second ago, remember that. But the goal is, if I like to say, if your car doesn't go into the ditch, you don't have to call AAA and get pulled out of the ditch. And that's truly what the goal is for the Beacon platform, is to mitigate against those really steep losses. Caitlin and I have an expression that we talk about stairs. If we're going up the stairs and we stumble, you might skin your shin a little bit and feel a little embarrassed, kind of look around and say, did anybody just see that? But you'll probably be okay. You'll live through it. But if you fall going down a long stairway, there's a real good chance you'll never get back up again. Or if you do, you might be severely injured. And I've seen that with folks, particularly back in 2007, 2008, 2009, and then also again later in 2020, when friends that were actually getting ready for retirement, early retirement, or others that were planning that, because of that steep loss, or minus 18% in 2022 of the S&P, it completely eliminated their ability to be able to retire. Now or maybe better or more accurately put, it's transitioned them to a much longer period of working than they wanted to or intended to, because their portfolios were decimated. So, Lou, that's one of the many things I do love about the Beacon platform. It's not designed to get the super high highs or avoid the super low lows. It's really designed to keep our portfolios going down till we have confidence to invest in the equity markets. But at the same time, we know we've got that downside protection that clients want so much, particularly as we get older. And we want to know that we don't have to be looking at the Wall Street Journal every morning to see, oh no, how did my portfolio do? And can I really afford to retire when I'm planning on it?
What we're trying to avoid is systematic risk, which is that risk that you can't diversify your way out of. Think recession, interest rates, wars. What does it look like? It looks like this. This is 2008, where no matter where you went, there were going to be declines in the equity portfolio. U.S. stocks were down 37%. REITs were down. So real estate was down 39%. Commodities, 35%. The only positive blip here was bonds, up 5%. Fast forward to 2022, where equities went down 20% and bonds went down 20% as well. This type of systematic risk is something that investors can't plan on. And that's why having an automated risk management solution like our 2.0 or 3.0 portfolios could be the perfect thing to keep them invested and allow them to take out high withdrawals during retirement.
So a couple other things is obviously, using this platform and using what are called sector funds, those 11 sectors, very inexpensive, which is, let's face it, costs matter with portfolio. In my retirement income certified professional designation course studies, one of the things that they hammered on significantly again and again and again was what is a safe withdrawal rate? How much that is, how much of our portfolio can we withdraw every year if we're planning on lasting for 30 to 35 years? And in fact, there's a latest statistic for if someone is 73 when they start taking their income out, according to the Bureau of Labor Statistics, the most recent information, and this is both male and female, by the way. So ladies, thanks very much for helping us guys a little bit on this. But for a 73-year-old, the life expectancy, the halfway point when half of those 73-year-olds will be dead and half of them will still be alive, is another 26.7 years, or in other words, 99.7. The reason I bring that up, it doesn't matter what your life expectancy was of your parents, your grandparents. It's a whole new world out there and a whole new generations. And this is why it's critically important that you keep both real estate, investment real estate, that's another topic, and you can find lots of stuff on our website about that and how to integrate investment real estate without having to own it directly. But this is why you also need to keep equities in a portfolio. Now, there are different flavors, and Beacon has different flavors as far as how much of the portfolio gets into the equity sleeve. But the important thing is we need to keep equities in our portfolios for the rest of our lives, because we're going to live, most of us live a whole lot longer than we've ever imagined. Can you picture your portfolio lasting to age 100 with confidence that you're not going to run out of money?
So for a retiree, depending on the year they retire, could determine a successful retirement or not. What's on the screen here are the sequence of returns for the S&P 500 from 2000 to 2022, except we put them in reverse order. So if a person retires here in the first year, they have a negative 18% return followed by a positive 28%, all the way down to 2000. They have a 7.94% average rate of return. If they put $1 million into this portfolio and they're taking out withdrawals, everything works out fine. They end up with 1.6 million. But if we look at these returns in the exact order that they happened from 2000 to 2022, this same investor who started with $1 million runs out of money by 2015. And this is sequence of return risk. And this is one of the main things we're trying to address with the Beacon risk management portfolios.
Now, Lou, you've got some really fascinating slides about again, more research. It's about data, right? Research about how much we could afford to take out with different kinds of platforms. So please walk us through this. This is fascinating stuff.
Right. What I think is really interesting, RJ, is even though the market over time goes up and to the left. Here's a slide that's showing almost over 100 years of data. And you can see the markets do really great. They average here over 9.1% average annual rate of return. But we forget about bear markets. And in between this great mountain slide, you see these periods of red that show the markets went into some form of a depression or a recession. And that brings up the question that clients ask, which is, how much can I take from my portfolio every year in, let's say, a standard 30-year retirement? And the standard recommendation is 3 to 4%. The 3% is more for like the S&P 500. This is they come up with these recommendations based on math. They use Monte Carlo simulations, which just takes a portfolio like the S&P and it runs it through thousands of simulation, maybe the best years first, the worst years last, the worst years first, the best years last. They take all of those thousands of scenarios, they mix them all up, and they come up with a ranking score that says what probability or what safety probability can we expect to take out a specific percentage and make it to a 30-year retirement. So for stocks, it's around 3%. Now, not everyone retires and goes into an all equity portfolio. So to the right here, we're showing a balanced portfolio. someone that's mixing stocks and bonds. And the recommendation there is 4%, which brings us back to the 3 to 4% standard recommendation for how much you can take out in retirement. But remember, Beacon eliminates the catastrophic loss years in the portfolio when invested in equities. So this slide, if you go to the fifth column here, there's the S&P 500 we talked about, a 97% safety ratio if you limit your withdrawals to 3%. But if we go here apples to apples, the fourth column, Vantage Aggressive 3.0, this is an all equity portfolio. We're able to take 5% distribution with 96% safety. And apples to apples, as we mentioned, the 60-40 portfolio, which was a 4% safe withdrawal, we can use our balanced here, which is apples to apples. We can take 5% of that portfolio. So we're talking about a 25% increase in income solely by having a risk management scenario in place to protect clients from catastrophic loss.
Fantastic. And I just want people to realize once you start getting into income, and probably many that are watching this video or videos, you're not at that place yet. You haven't started taking a retirement income yet. So you've got maybe some time to make up for some losses. But the point of it is, why go into the ditch anyway? If you don't go into the ditch, you don't have to call for the tow truck. And that's the brilliance of the Beacon strategy, is limiting the losses, but at the same time, in the opportunities where there's an upside draft going on, like right now, where the equity markets are overall doing quite well, we can have sort of the pedal to the metal. Now, my portfolio, I use the aggressive allocation. My wife, who's extremely cautious, but surprisingly, she's in the balanced, where up to 70% of the allocation will be in equities when times are good. But when times get rocky and there's that 10% drop from the high watermark, from the spot where that basket was the highest, when that pulls back by 10%, then the portfolios that are in equities go into all bonds. And right now, for the most part, that is U.S. government treasuries, very short maturities. They're constantly rolling over. And because the Federal Reserve is keeping interest rates higher and plans to for some time, according to the Fed chair, this is a great time for us to get nice returns with very, very, very little risk, because it's, for the most part, invested in U.S. treasuries. So, Lou, Beacon came up with a very clever idea, though, last year, that is called their market fund, the 3.0 market fund. And when I heard about the introduction, and as I found out the same day, I put 20% of my own portfolio into that fund, came back, and from the conference I was attending, put another 20% in. So I dove in headfirst into this fund. I love it, in addition to the rest of my portfolio, which is in the aggressive allocation. What is this market 3.0? Who would want to participate in this, and what's it designed to do? Who's it for, and what's it designed to do? You want to tackle that one?
Sure. Well, historically, Chris Cook, every time he goes into the lab, he comes out with something that's a little bit more improved from what we had before. So when you look at the last 24 years of the equity cycle, we find there's periods where value investing is more successful, and there's periods where growth investing can be more successful or have better short-term results. Our Vantage 2.0 and 3.0 portfolios are highly diversified. Again, all 11 sectors of the economy, equal weighted. Those fall under the category of value. And historically, since 2011, they have done great things for these particular clients that need equity participation, but they want to protect, especially in light of taking income during their retirement. But what about growth? Like 2023 was an interesting year because all indicators said be defensive. Most tactical managers out there were defensive in 2023. But the market was propelled by the magnificent seven large cap stocks that really kept the markets moving in an upward direction. Chris wanted to find out how do we capitalize on that. So he went back into the lab, came out with the Vantage 3.0 market portfolio, where instead of using 11 equal weighted sector ETFs, he built a portfolio that has half in QQQ, which is the NASDAQ 100, your technology stocks, AI stocks, and half of the portfolio in SPY, which is the S&P 500 ticker symbol. So half and half. These are rocket fuel. These things move in bull markets. You wanted to capture the upside, but still have a risk management process in place to turn those off. Again, think light switches. When the markets are doing great, like they are right now, we are fully invested, QQQ, SPY. But should they reach an apex and start to come down away from their normalized trading range, we will turn off those light switches. How will it work? Going back in history, and everything we do is based on math and history, not guts and guesses. We look back at those types of markets. 2022, QQQs were down up to 40% at one point. In 2023, they were up over 54% at one point. So such a volatile portfolio, we want to have the ability to turn that light switch off when it exits its normalized trading range. And that's the science behind 3.0 market portfolio. It's a binary. 2.0 is a binary portfolio where we're either all in or we're all out. Think one light switch, right? We're in all 11 sectors or we're out of all 11 sectors and sitting in treasuries. 3.0, on the other hand, looks at each sector individually and does the risk management at the sector level. On the screen here, we have an example of just healthcare. So what we do with 3.0, since all the sectors are not correlated and some sectors are more volatile than others, some sectors like technology could receive a 10% downdraft quite regularly, where a more conservative portfolio like utilities might only trip out once every couple years. So what we do is we look at each individual sector as its own individual economic unit, and we take a look at 5 different 200-day moving averages to create a normalized trading range that this investment should invest within. And what we do is when the ETF drops below what we call our bear trend line, we sell the portfolio. So over a 200-day period, of course, this channel will go up and down, but in a bear market, the channel will continue to decrease, which will make it pretty easy for the ETF to come back and the price to eclipse the bull trend line, at which point we purchase it again. So 2.0 is all in, all out. Think 3.0 like having 11 light switches, where if, let's say, financials drop, we will sell financials and put them in fixed income, followed by healthcare and industrials and materials. And at some point, we'll be all invested. At some point, we will not be invested at all. And some parts of the year, we might be invested in 6 or 8 of the sectors. So it's a more dynamic type of risk management strategy.
Now I know there's some listeners here that they turned the switch off in their heads.
How do you
starting to hear some of these things?
One sector,
if you're
overweight your
attracted at all to the ideas, anything that we're talking about, you can just send an email to info@wealthlegacygroup.com.
Each of the 11 sectors
wealthlegacygroup.com, or you can give us a call 858-569-0633. That number again.
I like looking. Let's start with the red one. Look at utilities. In 2010, utilities was one of the worst performers.
20 minutes just simply
so as a portfolio
unpacking some of
manager,
these things
think,
together.
Well, I don't want
whether you choose to hire us or not is immaterial.
However, the
How
next year,
you,
utilities is at the top.
Plan for
so
a
you
secure
decide,
retirement.
okay, we're going to go ahead and stay, or maybe even
radical retirement roadmap that should be coming out in the next couple months. But to give you more information as well, whether or not you're a client, the goal is just simply to add value to your life, to your portfolio, help you sleep better at night, and also have plenty of money you can spend on grandkids, travel, and a bunch of other fun things.
What we found by using 11
as we start wrapping things up,
sectors,
what are a couple more things that you wanted to share with us again about the Beacon story?
This is our first line of defense.
I'm just trying to think as well. We've talked about what really started
diverse portfolio
the Beacon concept and the issues and the concerns, the worries of investors. We've talked about the stop loss feature, which is so clever. but is also the mechanism and the math behind when to go back into the markets. We've talked about the advantage that Beacon has of being able to invest across the entire marketplace using the 11 sector funds, very low cost with Vanguard. We also have access to dimensional funds, DFA, and also some select American funds in the portfolio. One of the things, maybe if you could address the thing that I'm finding, is that there's a saying that nobody's deader than last year's hero. No one's deader than last year's hero. In 2020 and 2021, Beacon looked unstoppable. And then 2022, the S&P index was off by over 18%. Beacon went down, but not nearly as much, but it still went down. And I found then going in explaining that year as well as 2023, that some people tend to be very short-sighted and they forget about the enormous run-up they got in for a couple of good years and the math behind the Beacon approach. And they're chasing the highest and the best returns of the moment. Can you just speak to that a little bit in terms of folks that are chasing returns? And what's that do? Does it, at the end of the day, does that really work?
Isn't that the story of 95% of all investors in the world over the last 100 years or so? Clients are always doing the wrong things at the wrong time. I mean, you can go to your club and someone will talk about the incredible call they made on a particular stock, but very rarely do they walk into the establishment and say, hey, these were all my losers, right? So folks that are trying to time the market, I mean, even if you use fundamental analysis or technical analysis, those are guides. But in the short term, no one really knows where these markets are going. If we did, we all could have just got out of the market in 2000, got back in 2002. We all could have got out of the market January of 2020 and then got back in on April 1st. But none of us have that foresight. No matter what graphs you have or what tools you have, when the people vote and they start buying and selling stocks, they can move rapidly in a direction. That's why everything we do is based on math and history at Beacon Capital, not guts and guesses. Even tools that rotate from one investment to another. Maybe they take a 20% hit on an investment, move it to another stock, and then that goes down 20%. That's almost the definition of catastrophic loss, right? Losing 2 times in a row on 2 different investments. That's why we chose to do the risk on, risk off. When we're risk on, it's based on math and history. But when we're risk off, we're staying in some sort of an investment vehicle that'll pay us yield to park and just step outside. Looking at 2 different investments that have the same exact rate of return over 30 years. In this case, it's 8.05%. One of these investments is much more volatile than the other. It has over a 14% standard deviation, and the other portfolio has a just under 10% standard deviation. That means how high can it go, how low can it go, and what is the difference between the two? What we find is a lower standard deviation portfolio allows us to take a much larger safe withdrawal rate. So notice this, 3.9% versus a 2.5% safe withdrawal rate of the portfolio that had the higher standard deviation. Is that important? Well, it might not seem like much, 2.5% versus 3.9%, but that's 56% more retirement income for an investor by avoiding catastrophic loss and having a tighter standard deviation or a tighter range of returns.
Well, Lou, it's been so great having you with us. And I'm just so pleased, so very grateful to my friend Lou Tranquilli back on back in the New Jersey shorelines, who introduced me to Beacon. And so thankful and appreciative that he suggested that I understand the math and science that's behind Beacon and the algorithms. And it's very emotionless type of investing. And unfortunately, so often investors I found they fall in love with their portfolio. And so they ignore the warning signs. They don't have the downside protection that Beacon builds in automatically. And so if you're listening to this and you're concerned at all, worried at all about how can you grow your portfolios at an optimal rate, but at the same time have downside protection, so you're not worried about having your portfolio drop by 15 or 20 or 25 or 35%, then let's have a conversation. So again, we invite you to just give us a call, arrange for a complimentary conversation, no cost, just simply to talk about, we can certainly address the investment issues, but we can talk about so much more than that. We can address some of the issues that we find with their estate planning, with their insurance, with their tax mitigation, number of other areas as well. So give us a call on the number you've seen on the screen, and we'll be happy to have that 20-minute conversation to just help be a resource for you. Again, much thanks to Lou Bojorquez. It took me a couple of days to figure out how to spell that, but I can tell you that as you've seen and listened, Lou is an incredibly bright fellow. Got to tell you also, he's an amazing husband and father from all reports. And he's also truly been a lovely friend for us. So Lou, thank you so much for being with us today. And again, this is RJ Kelly with Wealth Legacy Group. God bless. Hope you do extremely well in what your day is, but more importantly, that you're also impacting the world in some sort of lasting, positive way. Bye for now.